the last 2-3 days, the gold price has gone ballistic. Very strong increase. A clear buying signal, not for the long term, but short term. In every society that has existed in the world, from the beginning of recorded history, 5000 BC until now, every paper currency has lost its value eventually entirely. The paper money has always gone to its intrinsic value, which is zero. Whereas, say, gold, silver, and platinum are until now difficult to manufacture artificially. I'm not saying it's impossible, because maybe one day it will be possible.
Recent movements across global precious metals show gold experiencing a massive price surge. Financial markets are watching closely as historical currency cycles reach a critical tipping point. Marc Faber, a well-known Swiss investor, commentator, and publisher of the Gloom, Boom and Doom report, emphasizes that every paper currency in recorded human history from 5000 BC to the present day has ultimately lost its value entirely. Central banking authorities continually expand money quantities, driving unbacked paper currency toward its intrinsic value of zero. In contrast, physical assets such as gold, silver, and platinum maintain rarity value due to strict mining constraints and physical durability. He predicts that while gold's recent sudden price surge provides a strong short-term buying signal, holding physical hard assets offers the only viable long-term hedge, as continuous money printing drives fiat systems to absolute collapse. Investors must realize that fiat currency constructs cannot endure endless central bank debasement without suffering total monetary failure. Now, we present the clips from Marc Faber's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Interest rates and commodity prices move in long-term cycles, and the peak in interest rates in the world, from a long-term cycle perspective, was in 1981. And after the inflationary period of the late 60s and 70s. And we peaked on the 10-year treasury at 15.84% on September 21st, 1981. And thereafter we went down in interest rates, in a secular decline in interest rates, and in other words, a bull market in bonds and in stocks. And then I suppose that interest rates would have had to bottom out somewhere in the early 2000s. But because of the Fed and money printing and artificially depression of interest rates, we were able to keep interest rates down until August 2020. And the 10 years bottomed out at the time at 0.5%, okay, at 0.5%. And since then, we are in a rising interest rate structure. Now, what this means is, as interest rates declined and the government debt expanded, it didn't cause any damage because the government could borrow money at lower and lower rates. So although the debt was growing, the interest burden was not growing. The interest burden was actually diminishing because the average interest paid on the total debt was diminishing. But that has changed. And suddenly now, the interest payments on the government debts are no longer $300 billion a year, but over $1 trillion a year, And with the deficits, and Trump, he doesn't care about debts. He's never repaid a debt in his life. And he's in charge of the country that has the largest debt in the world. And when you think about it, it's a horror show. Anyway, now the debt level is rising by the deficit every year, and that means the debt is growing at something like $2, $3, $4 trillion a year, and the interest payments are going up because the interest rates are no longer going down. Now, the Fed, in theory, the Federal Reserve, in theory, they can cut rates. But as you know, they started to cut rates in October 2024. But what did the bond market do? It didn't rally. Bond yields didn't go down, but bond yields went up. That is a very powerful signal that the Fed, the Federal Reserve, has lost control of interest rates. They control short-term rates. They can put each short-term rates at 0%. That they can do. But the 30-year Treasury will not rally on that, but will go down because they will say, okay, the government has no discipline anymore. And I tell you, the last 2-3 days, the gold price has gone ballistic, very strong increase, a clear buying signal, not for the long term, but short term. In my view, the gold price reacted that way, it was going up, because some people are scratching their heads. They see the government in America, specifically the Treasury, they want the Fed to lend money to Japan to support the Japanese yen. In other words, they don't want the Japanese to sell treasuries. So what they do, when you think it clearly through, they are lending money to someone so that someone can buy the treasuries or hold the treasuries. They don't want that. They rather lend the money to someone for him to hold the treasuries than to admit that they would sell the treasuries. And that is a manipulation that cannot end well. Now you say, of course, Mark, we know all this, but it could last for a very long time. Well, in the economic theory, once you embark on money printing, one of the issues is, can you just print a little bit of money? You cannot. You have to, either you stop it and you bring inflation down, and during that process, it's an operation like in a hospital. The economy tanks. It's very painful, but it can be done. But it can be done based at the beginning. Now, in my opinion, we embarked on this money printing exercise in December 2008. In my view, it's too late to rectify this abuse of the monetary system without any significant pain. You understand? But it can be done, but people will suffer, and the politicians, they'll be out, and the government will change and so on. But it could be done. But the Trump will not do that. He doesn't want the stock market to collapse because of his bodies and because of himself. His wealth is built on asset inflation. He would be bankrupt many times had not the system continuously printed money and lifted his asset prices.
The global monetary framework is navigating a profound structural shift as the multi-decade era of falling interest rates comes to an end. Following a 1981 peak at nearly 16%, Treasury yields steadily declined for 40 years, allowing sovereign governments to dramatically expand total debt while keeping interest burdens low. However, this dynamic reversed when long-term rates bottomed in August at 0.5%. Today, annual interest payments on government debt have escalated past $1 trillion. When central banks initiated rate cuts, long-term bond yields unexpectedly climbed higher rather than rallying, signaling a fundamental loss of central bank control over long-term borrowing costs. Furthermore, central banks extending financial loans to foreign allies simply to maintain treasury holdings represents an artificial market manipulation. Continuous deficit spending and accelerating debt growth continue to strain the foundational mechanics of the financial system. Now, let's get back to the interview.
Paper money is a construct, or has been created essentially by central bankers, and that they control the quantity of money, and together with the government, they have an interest to increase that quantity of money. And so over time, inevitably, in every society that has existed in the world, from the beginning of recorded history, 5000 BC until now, every paper currency has lost its value eventually entirely. The paper money has always gone to its intrinsic value, which is zero. Whereas, say, gold, silver, and platinum are until now difficult to manufacture artificially. I'm not saying it's impossible, because maybe one day it will be possible. But until now, it's impossible to manufacture them. And because of their limited quantity that exists and the high cost of mining, they have a rarity value. And they are not destructible. Say, if you keep a Picasso in your house and the house burns down, then the Picasso becomes worthless. But gold, it will not melt down. It will still be there. It will melt, yes, but it will still be there. Now the firefighter, if he's not very honest, he may take it. All our possessions, philosophically, it may be good. They are perishable. In other words, if you look at your life, you have possessions that you can use temporary. In eternity, a very small time frame of, say, 50 years or 100 years, and then you go somewhere else, and then you have nothing. I look at all stock markets in the world, and obviously the US market is very expensive, whereas, say, Asian markets, especially in Southeast Asia, are inexpensive. And you have lots of companies that are good companies selling at maybe 8 times earnings or 10 times earnings with dividend yields of 6-7%. But this is more the exception than the rule, and retirees will more likely invest according to an index like the S&P 500 or so. And the S&P 500, as well as the NASDAQ, are indices that are heavily weighted by expensive stocks. You understand? They are 30% of the S&P is technology and technology related and AI related and semiconductors and so forth. And so the index is at a high level. Number two, it's not a particularly good time historically seen to buy when there's euphoria in the market. And we can measure the euphoria by upside, downside, volume, and so forth. And there has definitely been euphoria essentially everywhere, and probably in South Korea even more so than in the US, where people leverage themselves to buy stocks. And third, I think it's overlooked. We have a major problem in the world, and this is the world, especially the Western world, not so much emerging markets, but the Western world has been living beyond its mean. Beyond its mean means we spent more money than we had, and as a result of that, the debt level in the world has never been higher. And not just on the individual level. In other words, your household borrows money to buy a car and so forth. That has always been the case. But at the present time, the governments are heavily indebted, and that debt doesn't go away unless there is a major crisis. And the interest on the debt has to be paid, and so the government has to borrow more money to pay the interest on the debt, and it may last for a while, that I agree, and I can live with that fact, but it can't last forever. You know, it's leading to a crash sometimes. Now, is the crash tomorrow morning or tonight or in 3 years? We don't know. But it's a situation where if I depended all on my retiree money, I would be deeply concerned about it.
Major Western equity benchmarks currently reflect extreme market concentration and elevated valuations. Leading stock indices like the S&P 500 and NASDAQ are heavily dominated by technology, artificial intelligence, and semiconductor companies, which account for roughly 30% of total index weighting. Historical metrics show that elevated market euphoria and heavy leverage often create fragile market conditions. In contrast, select Asian equity markets, particularly in Southeast Asia, present contrasting fundamentals where high-quality companies trade at single-digit earnings multiples, with dividend yields reaching 6 to 7%. However, broad investment flows remain crowded into expensive Western equities, ignoring the reality that Western societies have continuously lived beyond their economic means. Aggregate debt levels across individual households, corporations, and sovereign governments have reached historic highs. As a result, governments are forced to issue substantial new debt simply to service accumulated interest obligations, relying on continuous monetary expansion to sustain asset valuations. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.